yesterday, the RBA changed it in a change of pace, moved from putting up rates by 50 basis points a meeting to 25 basis points a meeting. The reason it told us previously that it was putting up by rates by 50 basis points a meeting was as the Fed was doing, taking away the extraordinary stimulus provided during the pandemic. But now what's happening is that they're pacing their moves to data in the Australian economy, and in doing that, are doing it at a slower pace. Now, we think they'll get to exactly the same position by doing it at a slower pace, but they'll get there some months after they would otherwise have done. We have two views. We have a view on the Federal Reserve, and where we get the view of where interest rates are going in terms of the Federal Reserve from where the Federal Reserve tells us interest rates are going, and that is in terms of the summary of economic projections that are released 4 times a year with their meetings. And at the moment, the most recent summary at the most recent meeting suggests that the Fed funds rate will get to 4.6% at the end of February. Where we get our view from the RBA, or for the RBA, is entirely different, and that is from a model that we have of Australian short rates that we publish in the quarterly, and that model is based on 32 years of data of the cash rate driven by variables in the Australian economy, including unemployment and inflation, and explains just under 90% of monthly variation. And where that model tells us right now is that is pretty much exactly what it was saying during the last quarterly, and that is that the equilibrium short rate in Australia has risen from 3.7% early in the year to about 4.2% now. So if fundamentals remain unchanged, we would expect rates to continue to rise to get to above 4% next year, but after the Federal Reserve does their increase. Notionally, if we continue to increase rates by 25 basis points a meeting, we would get to a level of 4.1% in May, 4.35% in June, and 4.6% in July. We are still in this economy in a very, very, very strong commodities boom. If you look at the RBA index of commodity prices, which was updated yesterday and is on front of the RBA website, what you'll see is that commodity prices have come down from their peak in April, but are still far, far higher than they were at the peak of the previous commodities boom, what we call the resources boom, earlier in the century. And it's worth recalling that where the cash rate peaked in that previous resources boom was 4.75%. So around about the level that we expect the Fed to peak rates this time is where the Australian cash rate peaked last time. So that's kind of, it's within this scenario, 4.2 to 4.6%. We expect rates to peak in the middle of next year. In terms of things that the RBA is looking at, they say consumer confidence has fallen and house prices are declining after earlier large increases. Working in the other direction, they say people are finding jobs, gaining more hours of work and receiving higher wages. In summary, they say the board expects to increase interest rates further over the period ahead. So what I think is going to happen is that they will continue to increase rates towards our model estimate, which is currently 4.2%, but at 25 basis points a meeting instead of 50 basis points a meeting. So rates will continue to tighten, but they'll continue to tighten more slowly, and they'll continue to tighten into the middle of next year. Are there any questions?
Looks like it's all quiet, Michael.
So hang on. Michael, previously you were saying that we were going to move in step with the US, and the reason for that was to keep the currency, balanced. The impacts for the Aussie dollar now that it's going to be slower on our end.
Well, you saw. It's very interesting that last week there was a panic with a mini budget introduced by the British Chancellor Exchequer, Quartine, who was actually a really brilliant economist. I've seen him. I've only seen him present, on YouTube, but he's a really smart guy. And he was much criticised for the mini budget he provided, and sterling got knocked down. Yesterday we fell 5% against sterling. But sterling is recovering this week, and we got knocked down. So if we're increasing slower than the Fed, a slower rate, then you'd expect a generally weaker dollar. Today we were weaker in a circumstance where sterling was stronger, the euro was stronger, and the Canadian dollar was stronger. So exactly so, yeah. Well, the two most important things in the model are inflation and unemployment. And what's really interesting about central bank behaviour in both in terms of the RBA and the Fed in recent years is it's become much more sensitive. Even though everybody talks about inflation, central bank behaviour in shifting rates is much more sensitive to changes in unemployment than it is to changes in actual inflation. And I think the reason for that is that both the RBA and the Fed have models in which we are, of course, living in both countries, both the US and Australia, are service economies. And the lower unemployment is, the faster wages growth is rising. And the faster wages growth is rising, the higher the higher core inflation will be in a services economy. So the real issue here is the level of unemployment. If unemployment continues to fall, and the RBA in its commentary says that they expect unemployment to continue to fall, that means that they'll continue to tighten. So that's really the number one issue, is where unemployment is, because that generates their view of core wages and core inflation. And the second most important thing, very surprisingly, is where inflation is. It's unemployment. Now, in Australia, in previous cycles, we've actually got past this problem previously by having, because we have this bipartisan skilled immigration program, which the US doesn't have, and the UK didn't have until now, very interestingly. And it's really interesting to listen Quartine, the new Chancellor of the Exchequer, talk about the impact of this skilled immigration program on the potential growth rate of the United Kingdom. They've very much got this idea of having a higher level of skilled immigration, as we have in Australia, which allows us to maintain a higher level of trend growth rate in Australia than is the case in the United States or previously in the United Kingdom. So what normally happens is you've got already a front-loaded group of skilled migrants coming forward to fill positions in the Australian economy to take up the positions in a very tight labour market such as now. But we've missed out on about 2 years of that. And so I think that that's really, this is really our short-term growth problem. This is how we normally avoid having recessions in Australia. We have those people available to fill those jobs. So, but now we've got this gap of about a year before we get the next 195,000 skilled migrants. And that's the gap in the Australian economy that generally might tighten things, might generate very high wages growth, might generate core inflation. So that's the growth problem we have to get to in the near term in the Australian economy.